So my name is Bjorn Tremmerie. I'm responsible for technology investments at the European Investment Fund. And for those not familiar with EIF, we're going to be giving you a little insight in what we do. I am investing in technology. I don't necessarily understand technology the way that you might all think we should do. I'm a fund-of-fund investor, which means that we're not investing directly at EIF. We invest in funds that in turn invest in technology. But we see trends, and we see how the European market has evolved from a market where nobody wanted to invest in European tech 25 years ago when we started investing, to now a market that generates global champions like the likes of Mistral in AI, less funding but almost equally performing, if not equally performing yet, like ChatGPT and the Anthropics and the Bards and what have you. Again, I'm not going to talk about the pure tech. I would not be capable of doing that, but I can talk about Europe has evolved from a cold market technology-wise in 25 years now to a market that really is generating good returns based on technology investing and increasingly pure tech, deep tech, science investing. EIF has been investing for more than 25 years in venture capital funds and private equity funds. We have a portfolio of over 1,500 funds, of which half are venture capital technology investing funds. And roughly 20 billion of the 40 billion there is invested in that portfolio. And if you have that exposure, you know how the market has evolved. And European venture, European technology investing has been on a roll. Even after the market correction in 21-22, we're making up 20% of global VC investments in startups. $1 out of 5 lands in European startups. And if you look at the early stage segment, $1 or €1 out of 4 is landing in European startups. So we've become relevant. And I can tell you, 25 years ago, that was almost zero. Because 25 years ago, we're in the hype of the dot-com, and then we had the bust, which meant that 25 years ago, we didn't have performance in Europe, which meant that nobody wanted to invest in it. This is a complex slide, but it shows the performance data per quartiles of European venture capital funds since '98 up until today. It's a bit like wine. You compare funds that are raised at the same time, at the same vintage year. You have 3 data points per vintage per year. It's the cutoff point between the first and second quartile, the cutoff point between the second quartile and the third quartile, also the median, and the cutoff point between the third quartile and the fourth quartile. Very quickly, in '98, in order to be in the best 25% of your class, the best 25% performing managers on net IRR terms, it was sufficient to have a net IRR above 5%. That is not good. That's why the market in Europe, venture capital-wise, technology-wise, was not attracting institutional money. Nobody wanted to invest in it because we weren't generating the returns. That's when players like we, the European Investment Fund, national promotion institutes, that's where we had to continue investing in the market. Because investing in technology is investing in the future. The best way to predict the future is to invent it. Invention, innovation, financing of innovation, that's venture capital. So we as public institutions, we could not ditch the future. So we continued investing, and luckily, the market went up, performances went better. In order to be top quartile, you already need to be above 10% between 2003 and the global financial crisis. Gradually, we got mature, and success was attracting success. The exit of Skype created the Skype mafia, the Zalando mafia, the Criteo mafia, the Klarna mafia, the Spotify mafia. Success attracts success. And the performance since 2009 has gone up. In order to be top quartile in Europe, as a venture capital fund, you now need to deliver to 15%, 20% net IRR or more. Otherwise, you're not in the best 25% of your class. That's institutional quality performance that is attracting increasingly institutional investors. That is why you have Lightspeed opening an office in London. That's why Sequoia has 5 partners in London. That's why you have also Bessemer with a team now in London to tap into innovation happening in Europe. Those VCs coming from the US are not charities. They're here because there's money to be made investing in European tech. Another myth we sometimes hear as well, that investing in European tech is a loss-making game. To lose money on a net IRR basis, you need to have a net IRR below 0. But let's look at the last 14, 15 years when European venture capital was mature. Most of the bottom tick marks per vintage are above the 0% net IRR line. That means that other than 2013, and we forget about the last vintage years because they're too young, but for most of the vintages, in each vintage, 75% plus of all venture capital funds generate a positive return. So it's very difficult to lose money investing in European venture, unless you really make an effort only to invest in the bottom 25%. Also, emerging managers in Europe perform. I've ranked the best 5 funds in each vintage top down by net IRR. And if you're an emerging manager, you get a green coat. Darker green if you're a first timer, a bit lighter green if you're a second timer or a third timer. And blue chip means that you're at your 4th or 5th or 6th generation. You can see that in the top 5, even the top 2, there's a lot of green. New managers, emerging managers perform as well. So they're a good way to tap into European innovation as well if you manage to select the good managers. This is the top 50 of our best performing venture funds in our portfolio of 700 VC funds. Number 1 generates more than 350% net IRR. Number 50, 25% plus net IRR. So that nobody dares telling you that you cannot make money investing in European technology through venture capitalists or directly if you're one yourself. It's not falling off a cliff after the number 50. The best 100 are still generating 20% plus net IRR. And what we have as well is we have managers that repeatedly, generation after generation, generate that return. In the top 50, I have 2 managers that with 3 funds are in there. I have 5 managers that are 2 times with a fund generation in the top 50. And if you look at the top 100, I have 1 manager where every fund I've invested in generates more than 20% net IRR. And that's the quality of managers that institutional investors want to find. And you can find them in Europe. You don't need to be in Silicon Valley. You can be there too. But if you're not in Europe, you're going to miss out on these managers that deliver really good performance as well. I'm going to do this quickly, but people continuously tell me again that you need to be in the US to make good money on venture. So let's take the comparison. The only sports that compares North America to Europe is golf. So let's do the Ryder Cup of top quartile cutoff points. The candle bars were my data. I don't have US data, so I needed to use a PitchBook database where I'm comparing the top quartile cutoff points. So the level you needed to be beyond in order to be top quartile in Europe. Mind you, they're higher than my candle bars. And I compare that with what you find in the US to be top quartile in the same vintage. Of the last 18 years, in order to be top quartile, 10 years of the 18, the level to be top quartile was higher in Europe than in the US. So if you're investing in top quartile funds in US or Europe, it doesn't make a difference. You're going to have equally good performance across the 2 sides of the pond. This is another way of comparing the US with Europe. This is data from the Invest Europe database. So they've made a study in September 23 where they compared all European funds in their database and in their survey with all the US funds for the period 1986 up until 2022. And if you took 5, 10, 15 and 20 year horizons, the European pooled IRR, the IRR that all these underlying cash flows from all these European funds generated was higher than what you find in the US. The only horizons where that's not the case is the moment you go on longer horizons, 25, 30, 35 years. Europe hardly exists venture capital-wise, so it's normal that the US has there a better performance comparatively. But over the last 20 years, as an asset class as a whole, Europe outperforms the US. We're also delivering alpha compared to what you can find in the stock market. So if you, again, this is the same study that Invest Europe made. If you compare all the performances of all the funds and their cash flows, and you were at the same moment that there's a cash flow on the venture capitalist fund, do a cash flow on the MSCI World or MSCI Europe, you would actually have an outperformance from the venture capital funds compared to an equivalent investment activity on the MSCI indices, be it Europe or the world. So also there, both on a net IRR and on a multiple basis, European venture is delivering alpha. And I think it's important that people understand this because technology investing can be done profitably. It shows as well that there are entrepreneurs out there that are investing here and that need to have the money. They need funders, because otherwise we will not win the autonomy or the sovereignty battle in the current geopolitical uncertain times. What we also see is that, yes, there has been a market correction. And if you want to take the glass half empty type of view, for the last 2 years, the only thing that people will say, yes, but it's going down compared to 22, and it's even more going down compared to 21. These are investment activity levels in European startups. But you cannot compare with 21 and 22. 21 and 22 were anomalies. Money was cheap. There was no barrier of entry. Anybody could become an entrepreneur. Anybody could become a venture capitalist because there was no barrier of entry. So we cannot compare with anomaly years. You need to compare apples with apples. And if you compare the activity levels now, even end of 23, first quarter 24, you see that the activity level in Europe is higher than pre-COVID times. And I can tell you in 2019, I was feeling quite happy in the European venture capital market. It was already on an upward trend, but we didn't have the overhyped exuberance and the fear of missing out behavior that investors were having. So we're actually not doing that bad. But of course, if you want to be a doom and gloom thinker, you're going to say, yes, still less than 21. But that's your choice then to compare with 21, which according to me is one of the worst years that we had for European venture, because it set the mindset completely wrong. What I also see now is that we start seeing the first signs of a market recovery, or at least a stabilization. Mega rounds, $100 million rounds are back. I already alluded to the 600 million euro round that Mistral raised just a couple of weeks ago at close to 6 billion valuation. That's a large language model startup from France. It was created 2 or 3 years ago only, and it's already valued at 6 billion. And you have American investors investing there as well, even though they probably had access as well to ChatGPT and what have you, or to Anthropic. Mistral is beating Anthropic on the efficacy of their large language models with a fraction of the funding, even if they raise 600 million. So yes, large funding rounds are back, and it's not just to fund the unprofitable growth. It is to invest in profitable models, or models that have a chance to really make a difference at the global scale. We might see the beginning of an IPO window opening. If you look at all the billion-dollar listings since 23, most of them are trading upwards since the listing price. This data came from the 8th of May. It's taken from Atomico's State of European Tech report. I've looked at the statistics yesterday, the share prices. Only one is now trading on top of Klaviyo, also below the listing price, and that's actually Ibotta. But in the meantime, we also had the IPO of Raspberry Pi out of the UK, and that's holding steady at the listing price. So we might see the first signs of an IPO window opening. And that's, of course, important for the tech environment as well, because it means that investors could get liquidity by listing. Some of the early entrepreneurs, founders, ESOPs might get into the money, and that money might become available to invest again in qualitative technology in Europe. What we also see is that startups start recruiting again. So if you look at the job openings, for 8 quarters in a row, roughly, job postings went down. And now Q1 24, we have a 40% increase in job postings for startups. And this is the PureTech stage. So what we also observe where we sit is that less and less, given the maturity of the market now, venture capital funding is in companies wanting to sell shoes over the internet. That we've done, that we've had. More and more, the market, technology, entrepreneurship is happening in real tech areas. So of course the climate and clean tech and energy transition space, but also life sciences. You have AI, deep tech, cybersecurity, defense, quantum. Those are all areas that if you look at the numbers where dollars and euros are being invested, it's in the deeper tech segments. It's not any longer only in the digital entertainment models, the gaming and what have you. It's also real deep tech. And I think with that, I've used up my 15 minutes. I don't know whether we have time for one or the other question, otherwise happy. And if not, don't go short on European tech. Thank you.